Hello, I'm Toycam, welcome back to another third channel finance information video. Today I wanted to talk about the big stock crash which has happened over the past week. You might have heard about it, it's been one of the worst weeks for stocks everywhere because of coronavirus fears, but there's been a huge crash over a whole bunch of different markets. Let's take the FTSE 100, the 100 largest companies in the UK. If you invested £1,000 just a week ago, you would have lost about 3% of that already. And in fact, I don't need to talk about this hypothetically. I did invest £1,000 precisely a week ago, and it's lost about £31 in value. This is what puts a lot of people off investing, because hey, it's not just the FTSE 100 that's lost a huge amount of ground in the past week that has a graph looking like this. It's also, if you look at, say, the Nasdaq 100, America's biggest index, as you can see, same downward curve for graph, even if it's gone up 0.3% in the last 24 hours. It's not just that, but also look at United Airlines holding. They've gone significantly down over the past week, almost losing 33% of their value, by the way, per individual stock price. Airlines are, of course, particularly hard hit. You can see Delta Airlines with a similar trend, happening as well, like, ooh, yep, heading on the downwards curve. Even if you look at stuff like Beyond Meat, which you might think is immune to coronavirus because it's just a meat-based company, and what's that? They've gone down from a peak of 126 all the way down to 89, losing 16% in a day, by the way. There are huge losses all over the stock market, and even outside of stocks, because this is something I recommend. But even if you think like, well, precious metals and stuff must be fine, well, here is the price of gold over the past week or so. Again, we've had some spikes, but then what's that? All the way down here, ending the graph kind of negatively. If we take the exact same look for silver or any other precious currency, you can see how they're significantly down as well. Let's take a look at platinum. Is that going to be the same? Yes, it is. Platinum is exactly the same. And long story short, every single thing is down. And this is why people don't like investing. I mean, why invest money here when it might go down to there? I mean, if you had £1,000 a week ago, or £1,000 a day ago, in fact, over a week, you would have lost about 10%. But if you had £1,000, a week ago, you'd have lost a huge percentage of it. And that's why I never invest, is what people might say, and what people do, in fact, say a lot. And especially on a channel like this, where I have recommended, like, hey, you should invest X amount a month, as much as you can, to try and get the the gains on that. You might think that it's kind of like, this is the point that proves the opposite. I mean, market crashes, am I right? But here's the deal. Everyone who invests, or at least everyone who invests knowing what they're getting into, knows that this is something that can happen. A lot of people panic, and those are the sorts of people who are over-invested in this sort of stuff. However, the truth is, this is something that does isn't just prone to happen. It's not a freak event. It doesn't mean coronavirus is going to kill us all, although I'm a little bit more scared seeing the effects it's having on pretty much every financial market all around the world, by the way. But yeah, the interesting thing about this to me is not the fact that, like, oh, it's gone down. No one told me it could go down as well as up, because again, this is investing. Investing isn't just free money. It's not putting your money in the bank. It is it's a risky return, but over the long run, it usually yields good things. And in case you're curious what I mean by that, if we look at, again, what you need to do every single time this happens is not say, I'm not going to invest. Whether that be something, wacky like gold or Bitcoin, whether that be, something like a direct individual stock, which I don't recommend, or whether that be a composite fund of a lot of different stocks, say the 100 best performing tech stocks in the United States, including companies like Apple, Microsoft, Amazon, Facebook, whether that be the 100 best companies, biggest companies in the UK, whatever composite stock, which is what I recommend because it's the most safe overall, they still can go up as well as down over a long time. However, the reason I'm making this video is to explain that this isn't a tragedy, this is expected, and in some cases, it is actually a good thing. How are stocks going down a good thing? Allow me to explain that. Even though I would say I have like several years worth of like trying to invest as much as I can every month. This might seem like the worst thing for me to lose 3% of that over the course of a day, but here's the truth, right? People know this is a thing that can happen. If you look at any index over the last 5 years, you can see how every now and then there are huge crashes. Look at 2018, for instance. Here is 7,500 in September of 2018, and in December it's 6,200. That is a big crash as well. I wouldn't say quite so sharp as this downturn, and there could be more to come on this down. But the truth is, stock markets don't generally crash forever. There are some very niche, weird exceptions. If you look at like Euro stocks, for instance, they have long recovery periods. But for the most part, stocks do go up and they do go down. This is why you don't invest in them. If this is why you don't put all of your money ever in them. Because if it was a guaranteed 8% a year money-making machine, then obviously everyone would do it all the time. But the truth is, this is the fact that it can go up and down, is something that seems obvious. But there's two things about this to realize. One, buying stocks here in the big crash is the best time to buy them. Knowing that they're now worth, even after the huge, crashes, they're worth 8,400 right now, whereas you could have bought them just 2 years ago for 6,000. That would be almost a 50% return if you'd bought at the dip as opposed to buying at the peak. So, high prices are good if you have all of your money in them already, but if you're buying any more, and as we recommend, buy a certain amount a month, that's what any finance, person will tell you. If you're buying every single month, then boom, a dip is actually an opportunity to buy in the long run. Think about over here, for instance, where people are like, oh no, it went from 4,000 4,600 to 4,200, it lost 10% of its value. Holy heck. Well, buying at 4,200 is a lot better than buying at 4,600, or to be more precise, you can buy more units, which means that that profit that you'd have right now, again, just 5 years later, almost doubling in 5 years here, by the way, but that profit you'd have 5 years later would be significantly increased. If you are a buyer, you want low prices, and one of the ways to get low prices is crashes. Crashes scare a lot of buyers off, and that's why prices go down. If there were enough buyers, then prices wouldn't go down. They scare buyers off, and that's what leads to the big prices like this. And this is why many investors, like even the biggest ones, like a Warren Buffett, will say, buy when be greedy when people are fearful, and fearful when people are greedy. Like when people are pushing the prices high, that's the worst time to buy and the best time to be selling. And when people are pushing the prices low, it's the best time to be, buying and the worst time to be selling. It seems like such simple advice, and it is such simple advice, but the fact that it's not so intuitive, despite the fact that it's as simple as buy something cheap, sell it expensive. That's all you need to do to make a lot of money. But the fact that all of your, the fact that emotions will get in people's way, and people will look at graphs like this and go, oh God, I better sell here because I wish I'd sold there rather than there. Don't think about trying to minimize your losses when it comes to a stock, because hey, whether you lose $2 or whether you lose $20 by selling a week earlier or later, you've lost money, which is suboptimal. No one wants to lose money. This is why I don't recommend a single company, by the way, because a single company can just go out of business. Whereas, let's say the 100 biggest companies, yeah, prices go up, prices go down, but in the long run, they go up. Again, sometimes those long runs are, gaps of like 5 years in between. If we look at the FTSE 100's long-term history, you can see how if you started buying in 2018, if you invested all of your money in that one date, which again would have been a bad idea, it would have taken all the way until just over here to get to that same point roughly. In fact, actually, if we look at this right here, the peak has actually not been reached since the 22nd of May 2018. There is someone who put a lot of money in on that day and has yet to see a profit from that even 2 years later. And a lot of people look at that and say, yeah, well, investing sucks. I mean, imagine losing that amount of money over that amount of time. But the truth is, as long as you only sell at a profit, which almost sounds like a weird way to say sunk cost fallacy, but no, as long as you try to sell at a higher price than you buy in, you will make money on any commodity out there. Some things such as individual stocks for companies that can go broke, such as gold, which, maybe we'll find a big resource in, maybe we'll go mining in space sometime as a thing, or maybe we will discover a huge deposit. It's unlikely, but possible. Bitcoin, maybe, quantum computing comes out and destroys that. Every single individual thing has a collapse point, and that is usually quite small, but the sort of collapse points you won't expect are the ones for the large markets, and the reason that your money will never become worth zero, and the reason you never have to get out early to avoid losing too much money, because you should never want to lose any amount of money, even if it's small. And the reason for that is because it's unlikely the 100 biggest companies in the UK or the 100 biggest tech companies pretty much in the world, let's be real, there's the chance of them all going out of business is very, very low. Even when you take the most ridiculous time periods like the 2000 dot-com bubble, which, again, everyone knows that was the hugest time for tech stocks. It did take them from 2000 to 2014. If you bought in at 2000, you would have been kicking yourself the whole time. Like, why? How did I just lose 75% of my money? It might have seemed at the time like, oh yeah, the internet's going to be worthless. In 2002, you would have lost 75% of your money, and a lot of people did sell right here. In fact, people sold the whole way down. Some people lost 20%, some people lost 50%, some people lost 75% of their money selling because they just needed to pay for something else, or they thought, let's get out of this before it gets worse. But the people who held on to it for 15 years, which is way too long just to break even, I'll admit, but they still, in the end, made their money back. And if they held on for 20 years, not 15, they would have still doubled their money. Doubling your money in 20 years is a pretty good worst case scenario for the worst time you could have invested, like 20 years ago to right now, right? Whereas if you invested, say 22 years ago, you'd have 8 times your money. But the point is, the amount of money you can make will vary. That might be a low percent a year, as low as like 5 or 6 if really bad things happen and you buy in at all the peaks. But the truth is, over a long run, unless the world collapses and you have so many more issues, the logic buy hard, this thing is true always. Crashes and down prices and stuff happen every single day. Sometimes they're in the news and they seem extra scary. This is the sort of thing that gets people emotional and people selling. But the real investors, the people with the real money, the people with a lot of that lying around, this is their best time to buy. They know the long-term success of these sorts of stocks, and that's why even if you've tried to sell your thing that you bought at 7,500 for 7,000 or 6,500 as it is worth today, if you try to sell that thing, someone will buy it from you. Again, in this case, it's usually a a tracker. So we'll just take a better example of, like, let's say United Airlines Holding, which I don't actually like United. I wouldn't invest in them because I don't. Again, I'm not a big fan of them as an airline, and also don't know about their long-term business model. But the fact that if you want to sell your stock at $61 and lose $20, someone will buy it from you. That's how markets work. If someone didn't buy it for $61.59 and they bought it for $61.58, the price would go down because that's the new accepted price. Basically, someone has to buy your stock from you at every point. Someone is buying every single time you're selling. So why make a loss selling, because it's gone down because you want to lose less? Why not, you might feel like a genius. At the time, you'd have felt like a genius if we go to, like right here. You'd have felt like a genius if you sold your, 2000 stock. If you only sold at a, 10% loss when some people sell at a 50% loss. But the real geniuses are the ones who waited it out until they sold at a profit. Making money is better than not making money. Buy low, sell high. If things go low, that's when you buy, if you can. Obviously, don't invest money you don't have to cover losses. Then that is the sunk cost fallacy. But if you're investing every single month and you're doing that for a long run of time, ideally, probably more than 20 years, that's why you do this. The kind of lesson in this video, the lesson I've learned over the last week, because again, it's been a bloodbath for every stock. I mean, if you actually look at the long run, it doesn't actually look like a bloodbath, because the thing I've learned about this is sometimes things look disastrous week by week. Again, imagine losing a third of the value of a company worth 15 billion in a week. It was worth 20 billion a week ago. 5 billion in value has been wiped off the earth. And the truth is, one, the value is sort of never there. I mean, stocks are only worth what people are willing to buy or sell them for, which, that's the biggest thing I would say is a sign against investing if you don't believe in the whole stock world. If you don't understand the fundamentals, you shouldn't invest in something, of course. But think about the fact that, even though over a course of a week it can get disastrous, over the long run, as long as you have a long enough period of time, you will make money. People probably thought the same over all of these dips that have happened over time. And although this is the worst one we can actually see over the last 5 years, I guess it's almost as bad as like 9/11, I would say, as far as airlines are concerned, because so few people are traveling. The truth is, in the long run, it works out. The lesson from this is, because I have learned a lesson in the past week that I guess maybe I'll share right here. Every single major pension fund that you'll find will have the kind of rule that towards the last 10 years of your retirement, they move the money from stocks and bonds and high-risk stuff into mostly just bonds and cash and much safer things, and you get much less percentage on your returns. Instead of making 8% a year like you'll make for most of your life, most pension programs automatically make sure that you cut down to trying to only make 3 or 4%. And I used to think like, oh man, those pension funds, they're being, real pussies about this one. Like, I don't want to make just, like 3 or 4%. I want 8% all the way, damn it. But things like this is why. If you were going to, let's say your retirement date was next week, and for some reason you still had all your money in stocks, you would have had to, and you had to cash it out because you just wanted to retire on the date of the 1st of March, you would have lost a lot of money over this past week. Stocks are great if you're willing to potentially not have access to the money for 5 years' time. That's usually the benchmark. And in some cases, it might have to be 15 years' time if you want to guarantee you make a profit. The risk of sometimes having to wait 15 years to make a profit is possible, but as long as you have time on your side, and if you're young, you have all the time on your side, you can always make money. Or, always asterisks unless the world collapses. And if the world collapses, you know what? You've got bigger issues than where your index funds are held. But yeah, with that said, I hope you all enjoyed this video. Maybe it was useful, maybe it wasn't, but I wanted to talk about it because, again, this is actually, I'll be honest, a part of me has been fearful. I looked at all my accounts just to be curious, like how much was wiped off over the course of the past week, and a lot of money, that was there is not there anymore, and it makes you realize a lot about how money and all that stuff works. So yeah. I don't know, cash loses money all the time, stocks lose money sometimes, but they can lose more money than cash does. And long story short, everything's losing money all the time, so spend it all right now. That's bad advice. Don't actually follow that. That's sarcasm. That's objectively bad. But whatever, and in the future, I kind of want to talk about net worths and stuff, because this ties into that a lot. A lot of, over this past week, a lot of billionaires would have lost billions, in some cases hundreds of millions, but, billions were lost this past week, but also sort of not, right? So I want to talk about that a little bit. But for now, thank you for watching, and I'll see you all next time. Third channel, don't care. Oh, no sponsors, no affiliates. Just talking about markets and stuff. Goodbye.